I want to go, Ken, to one of the great algebraic books, the giant Wendy Carlin of the University College of London, with their effort on the three-equation ISLM system. We have just had a natural disaster. We have had a massive COVID fiscal impulse. What does your world say of how we extract ourselves from a massive increase in the fiscal, a massive increase in debt?
Well, I mean, I think a lot of policy of the past couple decades, and frankly, a lot of the academic thinking and literature was predicated on we'd never have a war, we'd never have a big supply shock, interest rates would never go up, and guess what? Oh, and there'd never be inflation. And it's happening, and we have to make adjustments that people haven't seen for a long time. And I think it's going to be much harder than it was in the 1980s. The political environment's changed, the economy has changed. As you said, there's much more debt. The stock market's really high. People are very worried about inequality. It's going to be a heavy lift to try to treat this like a classic Keynesian demand shock.
Because of all the news flow, Ken, I have to turn to Obstfeld Rogoff in your excellence at IMF, following on from Rudy Dornbush. David Folkert's Landau speaks of a dollar stronger. He nailed that along with others. And here we are. How do you actually weaken the dollar?
Well, the dominance of the dollar in trade and transactions would be there whether the euro, they're $150 per euro or the opposite. I mean, that's a given. But, right now there's this concern that no matter how troubled the U.S. is, there are other countries that are in worse shape. So it's actually, going to take a change. I think a lot of countries are having to react because inflation goes up when the dollar strengthens. But paradoxically, we don't get that much benefit in the United States from the stronger dollar because so much of trade is priced in dollars, but the rest of the world has to react.
Well, let's talk about different parts of the world then, Ken, that may be hit by a stronger dollar more substantially. Are we on the verge of a currency crisis in any emerging markets?
Well, currencies have certainly fallen. I don't know, exactly. I'd say currency crisis. We're at risk of certainly debt crises in places like Turkey and some of the lower income, middle income emerging markets. My co-author and colleague Carmen Reinhardt at the World Bank's warning that there may be banking crises, and all of that, of course, may lead to currency crises. And in principle, the movement of the currencies cushioning and preventing things from, falling apart. But it's very stressful. I mean, having your currency fall and having inflation go up and having to raise interest rates. So the position, you're quite right, Kayleigh, the position of emerging markets is really tough.
And do rate hikes from central banks fix that, or do you need direct intervention?
Well, I think they're going to do a mix of both. Rate hikes help, but a lot of these countries don't really have the kind of, frictionless capital markets that we have certainly, in the United States. And so they're able to intervene, but you can only do that for so long. The Asian countries have a fair amount of reserves. Other countries have some, but you can't do that indefinitely.
Okay, so I would like to move the conversation from fiat currencies to the realm of digital and cryptocurrencies. Ken, Tom was pointing out my required reading The Curse of Cash. You look at the future of currencies, and digital currencies have a role to play. And I'm wondering how you differentiate the idea of CBDCs, central bank digital currencies, a potential digital dollar, versus the broader kind of speculative assets that cryptocurrencies seem to be at the moment.
Not a simple question. I mean, I think at the moment, if you think about the United States issuing a CBDC, you have to ask why they're doing it, because we can accomplish a lot of the things the same way in the current system by making tweaks. If you did it too well, you had a retail central bank digital currency, there'd be massive disintermediation that we're probably not ready to handle. I mean, there are small central banks that want to issue a CBDC, hoping they'll get some of the kind of business that crypto gets. But it's very different, something that's going to be information that the central bank sees, and cryptocurrencies where the general idea is to try to make it expensive to track you. I think central banks are way behind the curve, and governments in general, in regulating cryptocurrencies. They throw out the idea of having CBDCs to distract the conversation.
But Ken, what's so important here to your very courageous book, The Curse of Cash, is the why. You and I are on the same page. We both agree, where is regulation? Fine. What is the why of the delay?
I think it feels like the 1990s and early 2000s to me, when the financial system was inventing all these clever new financial engineering devices and saying, catch me if you can, regulate me if you can. And I hear very much the same things from the, young cryptocurrency pioneers. And there are a lot of ideas there, but they're wrong that they can't be regulated. But they're lobbying. We saw the Super Bowl, right, with 20% of the ads cryptocurrency. There's states like Colorado and Florida, which seem to want to be the next El Salvador. They're giving away a lot of money to try to control the regulation. They complain about the SEC, so they're pushing back hard.
Ken, one final question. Is Japanese yield curve control, is that in the next edition of Obstfeld-Rogoff?
I think it's not, it's something that works like in a zero interest rate environment, but it can come back to bite hard. And I think other central banks who toyed with it have backed off. And as interest rates rise, Japan will have its own problems.
Professor, did you ever think that we'd have a central bank that owned 50% of the outstanding bonds, let's say the JGB market? Are there limits to that, Ken? In your mind, are there limits to that?
Well, in a way, there are no limits to it, in the sense that central bank debt is owned by the government, and so it's just a way of issuing short-term government debt. But if interest rates rise and countries have very short-term borrowing, including through the central bank, they've either got to allow inflation to go up, or they've got to start unwinding a lot of that. And if global real rates rise, and I think they will continue to for a while, we're going to see a lot of pain there.